wondered why some organizations just seem to, well, run smoothly? They avoid big problems, navigate challenges, while others just seem to stumble again and again.
Yeah, it's definitely not just luck, is it?
Not at all. It's often this complex system working behind the scenes, kind of scanning for trouble before it even really starts.
Mhm.
And today, we're taking a deep dive into a really crucial piece of that puzzle, one that's often overlooked: internal control monitoring.
Right. Specifically within the COSO framework.
Exactly. And it's important to remember this isn't just some standalone idea. It's actually the fifth and final component within COSO's whole system.
Yeah, they all link together. Understanding this one helps make sense of the entire structure.
It really does. So understanding this piece helps you grasp the whole picture. Now, before we dive deeper, just a quick reminder, this deep dive is based on material from Farhat lectures. All the content, examples, and explanations we're discussing come from the comprehensive accounting resources over at farhatlectures.com.
Great resource.
Definitely. So whether you're an accounting student, maybe studying for the CPA exam, or you're already a professional, you should visit the website. They've got additional practice questions, video lectures, and lots of detailed support to really reinforce today's topic. And a special thanks to Professor Farhat for providing this valuable material.
Now you're here.
Okay, so let's unpack this. Monitoring. We kind of think we know what that means, right?
Yeah.
Just checking up on things.
Well, yes and no. In the context of internal controls, it's a bit more strategic than just a simple check.
Okay, walk us through that strategic layer then. What exactly is monitoring here and why is it so fundamental?
So monitoring isn't just, ticking boxes. Think of it more like the organization's own self-healing mechanism, maybe.
Okay, interesting analogy.
Yeah, it's basically these continuous activities,
Yeah.
regular evaluations of how good the internal controls actually are. And management does this.
And the goal is,
The goal is really to ascertain to make sure that the controls are working the way they were designed to.
right, as planned.
Exactly. And, crucially, that they get adjusted if needed. It's like a feedback loop, constantly checking the system's health.
So it's looking back at what's already in place.
Precisely. You're continuously looking back at those control activities the company set up. Are they still doing the job? Is the environment changing? Are they keeping up?
And if they're not,
Then it's about making those adjustments, getting them back on track, or maybe even making them better, more effective. It's definitely an ongoing process.
not just a one-time checkup.
Definitely not. That's a really important distinction.
Yeah, that is important. Because we have talked about things like independent audits of performance before as part of specific control activities. That sounds like a review.
It is a form of review, yes.
But this monitoring in the COSO sense, it's broader, isn't it? It's like an overall perspective for the whole company.
Exactly right. It's looking at the entire internal control system, not just isolated checks and balances.
Okay. So this isn't just about compliance then. It's about being adaptable, responsive in real time.
That's it, exactly. Yeah. Without effective monitoring, even the best controls can just wither on the vine. They become obsolete, maybe people start ignoring them, or they just stop working effectively over time.
Like a dusty rule book no one looks at.
Precisely. Monitoring is what keeps the whole system alive, dynamic, responsive. It ensures it actually works to protect the organization and help it meet its goals. It's about spotting issues before they blow up into major problems.
Before they hit the headlines.
Hopefully, yes.
Okay, so setting rules is one thing, but making sure they actually work continuously. That sounds like the real challenge. How do organizations actually do this? How do they know if controls are working? What are the sort of the eyes and ears they use?
Good question. That's where we get into the practical side. So one of the first key groups, really vital source of information for monitoring, is often the internal control department,
Okay.
or as most people call them, internal auditors. Their role is pretty unique and absolutely critical. Well, these are staff members, but they are explicitly independent. Independent from the day-to-day running of the business units and independent from the accounting functions, too.
Ah, right. That separation is important.
It's paramount. It means they can look at controls objectively without being influenced by the people actually doing the operations or the reporting.
Got it.
And if you remember when we talked about the control environment, that first COSO piece.
The foundation, yeah. Tone at the top.
Exactly. We mentioned how seriously the board of directors takes its internal auditors is a huge factor. A board that really backs them, empowers them, that sends a powerful message throughout the company
About what?
about their commitment to running smoothly, following rules and laws, preventing fraud, you name it. These auditors aren't just finding problems after the fact. They're helping to continuously improve things, potentially stopping disasters before they happen.
They're like the company's internal watchdogs then.
That's a good way to put it.
Yeah.
Sniffing out trouble. Yeah.
Okay, that makes a lot of sense. They're objective internal eyes. But what about more proactive alerts? Like, how does a company get a flag immediately when something's off without waiting for an audit?
Right. That brings us to another really powerful tool, exception reports.
Exception reports.
Okay, these are basically reports that automatically alert the company when something unusual happens, something outside the normal boundaries that a control activity should have caught.
So it's like the control system raising its hand saying, hey, look here.
It's a direct signal that a control activity either worked as designed by catching something, or maybe that something slipped through that shouldn't have.
Can you give an example?
Sure. Let's say a company had a strict credit limit policy for its customers. Customer A can only buy $10,000 on credit.
Okay.
If a salesperson tries to put through an order for customer A for, say, $12,000 on credit, the system should automatically generate an exception report.
It flags it.
Instantly. It tells management, hey, this transaction breaks the policy. You need to review this. It's an immediate red flag.
Got it. Simple but effective.
Yep. And they can get quite clever, too. Want a more intriguing one?
Yeah, absolutely.
Okay, imagine adding a new vendor to your payment system. Let's say the system generates account numbers for these vendors, maybe a six-digit number like 136225.
Okay.
Now, here's the clever bit. There's an internal rule, but the purchasing department, the people adding the vendors, they don't know this specific rule.
Ooh, secret rule.
Kind of. The rule might be that the digits of any valid vendor number must add up to a specific total, let's say 19.
Right, so 1 plus 3 plus 6 plus 2 plus 2 plus 5, that's 19.
Okay, so that one's valid. But what if someone tries to manually input, or maybe fraudulently add, a vendor with the number 136223?
1 plus 3 is 4, plus 6 is 10, 12, 14, 17. Doesn't add up to 19.
Exactly. So, boom, an exception report is triggered immediately. The system flags it because it violates that hidden checksum rule.
Wow, that is clever. It's like a hidden layer of security built right into the data itself.
It really is. It shows how controls can be subtle, but very effective, working silently in the background.
So it's not just about having rules people follow, but building intelligent checks into the systems themselves. That's fascinating. Okay, so we have internal auditors, these clever exception reports. What other ways do companies keep tabs on things?
Well, there are several other tools they use to build a sort of comprehensive monitoring net.
Okay.
One very common one is just budget reviews. Seems basic, but it's effective.
Yeah.
Management regularly compares actual performance against what was budgeted.
Looking for big differences.
Exactly. Big variances. Are sales way higher or lower than expected? Are costs for materials or labor way off? These deviations act as flags.
Prompting them to ask why.
Precisely. Why did this happen? Are the controls not working? Did our assumptions change? It forces an investigation.
Makes sense. What else?
Then there are reports by regulators, especially in certain industries. If you're in banking, for example.
Oh yeah, they're heavily regulated.
Extremely. So reports from bodies like the FDIC or the Federal Reserve, their findings on your bank's health and compliance, those directly serve as a monitoring tool.
It's like an external checkup on your internal controls.
Exactly. An external validation or sometimes a critique. Another big one, particularly in manufacturing, is quality control.
Like ISO standards.
Yeah, things like ISO 9000 or ISO 8000. Just maintaining those standards requires continuous monitoring of your processes and the quality of your output.
Right, you have to keep checking.
It inherently involves checking if your controls are effective in producing consistent, high-quality results. You're monitoring the process constantly.
Okay. Budgets, regulators, quality. What about people?
Absolutely crucial. Feedback from employees is perhaps one of the most valuable, though sometimes overlooked, sources.
The people on the front lines.
Exactly. They're the ones dealing with the processes day in, day out. They often see weaknesses or workarounds that management might miss.
Like someone finding a shortcut that bypasses a safety check or something.
Perfect example. That's why many companies set up anonymous channels like whistleblower hotlines, 800 numbers, secure websites.
So people feel safe reporting concerns.
Right. Without fear of reprisal. It's not just good for morale. It's a really powerful early warning system for control failures.
Okay. Any others?
One more big one. Complaints from customers. Monitoring what customers are saying about, say, billing errors, product quality issues, service problems.
Oh, like online reviews.
Exactly. Think about Yelp for restaurants. Travelocity for hotels, Google reviews, Facebook, Better Business Bureau complaints.
So companies actually monitor those platforms.
The smart ones do. They treat those external platforms as powerful internal monitoring tools. It's real-time external feedback on how well your internal processes are actually working.
Like if suddenly everyone's complaining about being double billed.
That's a huge red flag. It could point straight to a breakdown in your invoicing controls. You need to investigate that immediately.
Wow, okay. So it's a wide range of things, from internal auditors to Yelp reviews. That's quite a net. Now, we've talked about the components, the tools, the eyes and ears. But maybe let's zoom out again for a second.
Yep.
When management is designing and implementing any internal control, not just for monitoring, but across the whole COSO framework, what are the sort of fundamental concepts they always have to keep in mind, like the underlying philosophy?
That's a really important question because you're right. These two concepts underpin everything in internal control. They apply across the board, not just to monitoring. They're sort of inherent truths about control systems.
Okay, what are they?
The first one is reasonable assurance.
Reasonable assurance, meaning?
Meaning that internal controls are designed to provide reasonable assurance, not absolute, 100% guaranteed assurance.
So they can't promise to prevent everything bad from happening.
Exactly. It's fundamentally impossible. Think about, I don't know, child-proofing a house. You can put locks everywhere, gates up.
But a determined kid might still figure something out.
Right. Or maybe forget to latch the gate one time. There are always possibilities for things to go wrong. And honestly, the cost of trying to achieve absolute 100% assurance would be astronomical.
Probably impossible, even then.
Likely impossible. Human error, unforeseen events. So the goal is a high level of confidence, a reasonable level, that objectives will be met and major problems avoided.
But not perfection.
Okay. Reasonable assurance. What's the second concept?
The second one is inherent limitations.
Inherent limitations, meaning built-in weaknesses.
Sort of. It's
Yeah.
acknowledging that even the best designed control system has natural boundaries, potential weak spots, things that can undermine.
Like what?
Well, two classic examples are, first, management override. This is when management themselves intentionally bypasses the controls. Maybe for personal gain, maybe because they think they know better.
They break their own rules.
Essentially, yes.
Yeah.
And second, collusion. This is where two or more employees work together to get around a control. A control designed to stop one person acting alone might be defeated if people conspire. Okay. So even a great system isn't foolproof because people can override it or team up against it.
Precisely. Those are inherent limitations you always have to consider.
So for you listening, why is understanding this reasonable assurance and inherent limitations, why is that so critical? Whether you're, building controls, working within them, or maybe even evaluating a company, it sounds a bit like a disclaimer, but it feels more important than that.
Oh, it's much more than a disclaimer. Couldn't agree more. It's vital because it sets realistic expectations.
Right.
It informs your whole approach.
Yeah.
If you know controls aren't perfect and have these limitations, you look at them differently. You don't just ask, is there a control? You ask, how strong is it? What are the risks of override or collusion here?
You become more vigilant.
Exactly. It encourages that continuous vigilance we talked about with monitoring. You recognize the system needs ongoing attention because these limitations always exist. You're prepared, not shocked, if something does go wrong despite the controls.
That makes sense. It tempers expectations, but sharpens focus.
Well put. And thinking about it, we've actually touched on all 5 components of the COSO framework now throughout our discussions. It might be worth just quickly recapping them to see how monitoring really fits in as that final piece.
Yeah, good idea. Let's tie it all together.
Okay, so first, component 1, the base. The control environment, that's the tone at the top, right? The ethics, integrity, competence of the people led by the board and management.
The foundation. Got it.
Second, risk assessment. How the company identifies its risks, analyzes them, figures out how to respond to threats against its objectives.
Knowing what you're up against. Okay.
Third, control activities. These are the actual policies and procedures. The actions taken to mitigate risks, authorizations, reconciliations, separating duties, physical security, the nuts and bolts.
The specific rules and actions. Yep.
Fourth, information and communication. How relevant information gets identified, captured, and communicated throughout the organization and also externally. Making sure everyone knows their role regarding controls.
How the messages get through. Okay.
And finally, number 5, what we focused on today, monitoring. That ongoing evaluation process, making sure all the other components are present and functioning effectively over time. Are controls working? Adapting. Is communication good? Is the environment still sound?
Ah, okay. So when you listen like that, you really see how monitoring kind of wraps around and checks on everything else.
Exactly. They're not separate boxes, they're deeply interconnected. You need all five for a robust internal control system.
It's not just about having the rules, like you said, the dusty rule book. It's about making sure they work, they're communicated, risks are being assessed, and the whole thing evolves.
That's the key. Monitoring is what drives that evolution. It keeps the whole system tuned, adaptive, and resilient to change.
Right. Well, we've certainly covered a lot today. We've navigated the intricacies of internal control monitoring, from the crucial independence of internal auditors, those really clever exception reports.
The secret vendor codes?
Yeah. All the way to listening to feedback from employees and even checking Yelp reviews. Hopefully, for you listening, you now have a deeper appreciation for these, well, often unseen systems that are working constantly behind the scenes.
Keeping organizations running properly, protecting assets, safeguarding reputations.
It really is like a silent guardian, isn't it? Working away to ensure things are accurate and to stop issues before they get too big.
Absolutely. And maybe, just to leave you with a final thought to mull over,
Okay.
consider how these ideas, monitoring, feedback loops, exception reports, might apply beyond just big company financial controls. Think about other areas of your own life or work.
Like what?
Well, how might you monitor progress on a complex project? Or manage the dynamics within a team? Even track your personal goals or finances? Are there feedback loops? Are there exception reports, things that signal when you're off track?
Ah, interesting. Applying the concepts personally.
And critically, what hidden inherent limitations might exist there? Maybe your own management overrides procrastination, or collusion, bad habits reinforcing each other. Are you truly monitoring your own systems effectively?
That's a great point and a challenging question. Understanding these systems, whether it's COSO in a corporation or just how you manage your own tasks, it really can give you an edge, Cam.
Definitely. Helps you identify and manage risks better.
And ultimately achieve your goals, whatever your field. So keep asking questions, keep exploring these ideas, and keep diving deep.